All right, so for the third day, we're still on this middle section. Talking about adjusting entries again. Remember, if you look on a timeline, accrual entries would happen before the dollar amounts or dollar signs, and then afterwards would be the deferred-based entries. Why do we adjust? Why do we need to adjust? We have to record what we used. Because would things be understated and overstated otherwise? If we didn't record adjusting entries for supplies, would it look like we have more assets than we do? Yes. Okay, so assets would be overstated, and they really haven't. They really shouldn't be because we've used some of those supplies. So as we talk a little bit more about the accrual entries, I'm going to go faster than I did yesterday because you understand it a little bit more. Taking a look at revenue. Revenue came in, money came in. No, it hasn't. Getting myself confused again. In October, Pioneer Advertising earned $200 for advertising services not to have been recorded yet, and that simply was an AR debit and a service revenue credit. And you might say, why? That's not any different than we've learned before. I guess I didn't realize it was an adjusting entry. Yeah, that looks just like entries we've done in the past. Would you agree? Okay, it's just that it's an adjusting entry because it's happening at the end of the month. We haven't actually done our work yet, but we know what happens when that AR changes when they pay their bill. Okay, remember we've got a debit, so down here has to be a credit. This is balance sheet, so the other half has to be income statement. Again, I wanted to go through that fast because we did it once yesterday. The bottom, Pioneer receives cash of $200 for what happened before. So basically later in the next month, we had AR pay the bill. So out of all the transactions, that's not really new. Out of all of our adjusting entries that we're learning, that's not really new. It's just presented to you in an adjusting entry format. This one I wanted to actually reroute because my PowerPoint lectures didn't have space to actually do a transaction, and that bothered me. And so that's where I should have stopped yesterday, but that's okay. Notice they got paid here, and they're not getting paid again till November, but right here is where the fiscal period ends. So we basically have 3 days of pay that we owe to who? Our employees have worked 3 days in that last part of October. What's the payable here? Who do we owe? If our employees have worked 3 days, we owe them. Okay, so we have a new account. It's called Salaries and Wages Payable. I'd write that in somewhere. Make yourself a little T, even though your original handout didn't have room for it. A payable, of course, is a balance sheet account. So this one has to be an income statement account. What do you think it's called? What's the contra account? Any idea? It is, yes. Thank you, Ira. It's salaries and wages expense. Well, when we owe someone, it's a credit. And how much? $1,200. So this one has to be the debit. And if I put the transaction in, salaries and wages expenses, the debit of $1,200, salaries and wages payable is also $1,200, but a credit. And if you think about it, the expense of business went up in those 3 days because we have to eventually pay our employees, but the payable or the liability goes up because we're not going to pay them until November 9th. We owe them that, and we have to stop our books and say, well, what happened? And you might say, why horse around with this? We're going to pay them in November on the 9th, but we have to stop and clean up our books. Remember, it's ethical reporting when it comes to accounting. That fiscal period ended, so we have to adjust for what happened. Why is this an accrued expense, not a deferred expense? Think about the timeline. When's the money going to come? Later in November. But we have to adjust for what happened even if there wasn't money involved. So I wanted to be a little bit more deliberate than what the PowerPoint originally was. Here's another accrued expense. So again, I see the word accrued. Does that mean dollars are happening yet? No. So we've got equipment. That's a whole nother account. We've got equipment. We know that our cars do not maintain their value. Equipment is the same way, whether it's a payloader or a combine, okay, or a cash register even. So on this equipment, we have a new expense called, or excuse me, the accumulated depreciation on equipment. It's actually a balance sheet account, but it contradicts the value of our equipment. Again, I'll say it one more time and complain about the book. I wish they wouldn't show you this yet, because this is a whole nother chapter. Why am I putting 40 in there instead of 480? Why am I putting 40 in as my credit? 40 per month. Overall, over the 12 months, my equipment is going to lose value of a $480 amount. Okay, well, I know no matter what's going on here, I know this has to be a debit because that one was a credit. I also know it's got to be an income statement account because the other one was a balance sheet account. And it's going to be called depreciation expense. Now, the cool thing about this was labeled an accrued expense. So you can tell that most of the debits are going to be expenses. Because it's the cost of doing business. It's costing me 40 bucks to have this piece of equipment depreciate in value. It's just like turning on the lights. It's the expense of owning equipment to do business. It will depreciate over time, but from an adjusting entry perspective, we have to go back to these rules of balance sheet debit credit, and it's an expense of doing business, just like flipping the lights on. Plus, we're putting gas probably in this piece of equipment or plugging into a wall and having utilities run it. So you can tell something like equipment is expensive to have around because you have to fuel it or power it, plus it's going to lose value. Think of the expense of our school bus fleet. It's a huge expense for the Morris Public Schools. Plus you have to put drivers in there to drive them. Wow. And every month, the value of those buses, or in this case, the value of the equipment goes down a little bit, and that's eaten into an expense. Let's do, how many more are there? Is this one in yours? Okay, good. Another expense, accrued expense. When we have, especially notes payable in this case, we have interest happening as we go through that, okay? So it looks like we have a note payable, which we know is a longer payable, so that is usually a loan in the form of what's called notes payable. It looks like we took out that loan on October 1st. The note requires an annual rate of 12% interest. Now there again, this is a whole other unit in this book. But if you take a look at our $5,000 loan at 12% interest, as far as how much are we chipping away at paying interest, 1 month, because it was on October 1st, and now we're talking October 31st, we're paying $50 interest in October. So we have to adjust for that expense. Have we paid our $50? No, but $50 has accrued or started piling up. So we've got two accounts here. We have interest payable and an interest expense account. If we owe $50 eventually, that's a credit. The other one has to be a debit, and that's the expense of having a loan. There's been no money exchange because remember, it's the accrued. It hasn't gotten to the dollar amount part on that timeline. So we have not paid this money, but it has happened. We've had this loan for 1 month, and $50 has applied towards that $5,000 that we borrowed. This takes a look at the 4 major types of adjusting entries. These are also known as the deferrals. These, of course, are the accruals. It gives you a snapshot of what's debited, what's credited. And had we not done the adjusting entry, so the accounts before the adjustment, it talks about what would be overstated and understated. We're going to do 2 exercises today. The first, you're going to have to label one of 4 things, and then we're going to actually do a few adjusting entries, like with them all mumbled together. I do not think there is a workbook page for the first one. You can just find a notebook page. You might want to have this page handy, though. It's going to help you. If you're feeling fuzzy, like, whoa, how am I ever going to remember all of that? Remember, we're going to do them and do them and do them again. I want to do these 2 exercises today. I want to do those 2 exercises tomorrow and maybe even add a few more. I'm not going to move on to that last section of the book until Thursday. I want to do 2 days worth of work here, just so they really start to sink in with the different kinds. Please don't do exercise 3.6 and 3.7 over the evening by yourself. I'd rather work through them with you tomorrow. And as mentioned, I'm on page 138 in the book. So for exercise 3.4, basically here's the answers. It wants to know which of the 4 big types of adjusting entries the mentioned in the book applies to. So if I look at, I'm on page 138. If I look at exercise 3.4, there's 1 through 11, but then the instructions are at the bottom. Identify what type of adjusting entry, prepaid expense, unearned revenue, accrued expense, or accrued revenue, is needed in the situation. Okay. So the 4 categories that I just mentioned in your handout is what would be the potential answers. Just remember this timeline, and I want you to write it in right here. That little timeline will help. Accruals happen before the money shows up. Deferrals are once the money's come in, then we readjust. Okay, let's take a look line by line. Number 1, Hart collects $1,300. I'm going to stop right there. Which side of the dollar sign are we on? On the deferral side. Okay, so then from there we got to just figure out which one it is. Hart collects $1,300 from a customer in 2014 for services to be performed in 2015. So it does not have the word accrual with it. Rather, it's unearned revenue. And if you would like to put a def behind that for deferral, that'd be a good idea. So in other words, we've got our money, but we haven't truly earned it. We've got it, but we haven't earned it. Some customers paid us, but we have to do our work. Number 2, Hart incurs the utility expense, which is not yet paid in cash or recorded. Accrued expense. The lights have been on, but we haven't paid our light bill. Number 3, Hart's employees worked 3 days in 2014, but will not be paid until 2015. Is there money involved yet? No. So accrued expense. This happens all of the time. Think about your own jobs that you're in, you guys. You work some days, and you better hope they pay you, right? And so it's an accrued expense. The work has happened, they just haven't paid people yet. Number 4, Hart performs services for customers, but has not received any cash or recorded the transaction. So if we've done work, but there's not been any cash paid to us, it's an accrued what? Revenue. We've done work, the customers haven't paid us. So it would be an AR debit and a revenue credit. And that's the weird one, because how's that different from what we've done in the past few chapters? It's not really. It's just now it's got an adjusting entry attached to it. Number 5, Hart paid $2,400 rent. Stop there. It's not accrued. It's definitely deferred. Hart paid $2,400 rent on December 1st for 4 months. Prepaid expense. They've paid their rent for 4 months. Number 6, Hart received cash for future services and recorded the liability until the service was performed. Accrued revenue. No, I'm sorry, unearned revenue, which is a deferral. Okay, they got a bunch of cash, and now the liability, we owe the work done. Number 7, Hart performed consulting services for a client in December, and then on December 31st, it had not yet billed the client for the services. Accrued revenue, it happened, they just didn't pay us. It's going to be exactly that AR and revenue sequence again. Number 8, Hart paid cash for an expense and recorded an asset until the item was used up. If we paid cash for something, and then we're going to continue to use it, which one is that going to be? Prepaid expense. An awesome example would be the supplies one. You go buy a bunch of supplies, you buy them on the front end, and then you record what was used at the end. That's what they do in the next one. Hart purchased $900 of supplies in 2014. The year-end $400 remains. The same, basically the same thing we just talked about. Number 9 would be prepaid expense as well. Number 10, Hart purchased equipment. The equipment will be used for 5 years. Do you think that equipment will still have its same value? No, it's going to have accumulated depreciation and depreciation expense that goes with it, which is a prepaid expense. We know it's going to chip away at value throughout the course of its 5-year life. And finally, number 11, Hart borrowed $10,000, signing an 8% 1-year note. Okay, well, have we paid that yet? No. But is some interest ringing up every month that goes by? So it's an accrued expense. It's piling up what we owe. So interest payable and interest expense. Remember that. I think that that's a helpful piece. The book doesn't explain it that way, but that lovely little video I found did. And going back to that little synopsis on that last page of your notes that I've given you is really helpful as well. Let's do some adjusting entries. There is a page in your book for this. You can find exercise 3.5 in your workbook. And these 7 transactions will be the last thing that we do today. Okay, so I'm on the bottom of page 138 in the textbook. It says, Vernikova Company has the following balances basically in the trial balance. Like, here's what they show. AR is nothing, accumulated depreciation is nothing. You see 7,000, 0, 10, 21, you see those in there? Okay. And the information below has been gathered on December 31st. So like that was the snapshot before the adjusting entries. Now we've got these 7 adjusting entries that we have to do, and we may need to reference the balances up there because that's what we started with. Below is what we ended with. With adjusting entries, you'll find sometimes you have to go hunt for the number, and sometimes they just straight up tell you. The stuff will look like this. It will be debits and credits. One thing I want to label it with additionally is it a balance sheet or income statement account? One thing I won't be doing are the T's. Okay? Do you think we can do this? All right. Number 1, Vernikova Company borrowed a $10,000 note by signing, or I said that wrong, borrowed $10,000 by signing a 12% one-year note on September 1st. I see interest expense as the debit and interest payable as the credit. On a loan, we haven't paid this thing yet. I think it said a one-year note. But there's interest piling up with it. Do you have an extra line before the number 2? Okay. On that extra line, I want you to do your math. Put your $10,000 loan in times 12%. Let's think about why we're taking it times 4/12. When did we take this loan out? September 1. So we used it all of September, all of October, all of November, and all of December because we're doing our adjusting entries at the end of December. So we've used our loan for 4 out of 12 months. So we've had $400 of interest pile up on that $10,000 note. Which one is our balance sheet account? Is it interest expense or interest payable? Which one belongs on the balance sheet? Because that's part of ALLO. A payable is a liability. An expense is part of the revenue minus expenses to be an income statement account. Is this a accrued adjusting entry or a deferred adjusting entry? It is accrued. The money has not happened yet, but 4 months have gone by and we've piled up some interest that we owe that we'll eventually pay. Number 2. Account of supplies on December 31st indicates that the supplies of $900 are on hand. Is that what we used or is still there? That's what's still there. How are we going to know what we used? Go up above and find the value of the supplies. What did we start with in supplies? Wasn't it 2,450? Is that what you said? 2,450 minus the 900 that's still on hand ends up being 1,550 that we used. Supplies themselves a balance sheet account. The expense side is always income statement because remember, revenue minus expenses is what shows up on the income statement. And we have our debit and our credit. So we're following the adjusting entry rules. We have a debit, we have a credit, we have income statement, we have balance sheet. Taylor. Yeah, it's 400. Yep, the debit and the credit. Sorry, I don't want to move my recording because it will quit moving. Good question. It's a 400 and a 400. Yep. And that math came from taking our $10,000 loan times 12% for the September, October, November, and December, the 4 months that we used it. Speaking of numbers, where did we get the 2, 4, 5, 0, and 900? Was this the beginning minus the ending? Yep. Number 3, they made this one easy for us. Depreciation on our equipment was $1,000. So our equipment, valued at $7,000, actually lost $1,000 of value in this current year. That's an expense of doing business, isn't it? So the expense is the debit, depreciation expense. What's our credit? What new account did we learn about? That's our debit. What's our credit? Accumulated depreciation equipment, and you're welcome to abbreviate that some. Depreciation expense is income statement. The other one is balance sheet. We'll learn more about how that works on the balance sheet in a later chapter. Number 4, Virakova Company paid $2,100 for 12 months of insurance beginning on June 1st. Have we used some of our insurance? If it happened in June, we used insurance for June, July, August, September, October, November, December. We have used 7 months of insurance. Are we just going to throw the other months away? No, but we have to account for what we used. What do you think the debit's going to be? It's an expense. Insurance expense, and the value of prepaid insurance has gone down. The math to get there, we had a $2,100 insurance policy times June, July, August, September, October, November, December. Those 7 of 12 months were used. And that's how we got at that $1,225. So the 7 is what months used from June to December. Insurance expense, I see the word expense, that's income statement. Prepaid insurance is an asset that we own that would show up on the balance sheet. Had we not done this adjusting entry, would our assets be overstated or understated? Over, because we used, out of a $2,100 policy, we used over half of it. And our prepaid insurance or our assets would have been overstated at that point. Number 5. On December 1st, Virakova collected $30,000 for consulting services to be performed from December through March. Accrual or deferral if cash is on the table? It's a deferred-based account. Unearned service revenue is our debit because we have not done our work. Service revenue is our credit. This bit, our debit, is a liability, so that's our balance sheet account. Why is unearned service revenue a liability? We owe these people who have paid us 30 grand. Service revenue side of it, though, is income statement. Now, wait a minute. I thought they paid us 30 grand. Why are we only adjusting for 7,500? Well, they paid us for work for December. Actually, I'm going to switch pen colors so you guys can see this a little bit better. December, I'm going to draw a big line like that. Then January, February, and March. They paid us for 4 months of work, but we're stopping after December and saying, hey, well, we've done 1/4 of our work, 1/4 of our 4-month contract we've done. So that's why you're taking the 30,000 times 1/4. We've done 1/4 of our work from December, January, February, March. So can you tell you have to really pay attention to the dates that they're giving you? Two more to go, you guys. Number 6, Virakova performed consulting services for a client in December of 2014. The client will be billed $4,200. This is the weird, easy one. AR is our debit. Service revenue is our credit. That's the one that's not too different from what we've learned. If we've done the work, we have a service revenue credit, which belongs on the income statement. But part of that, why do we own that asset? What do we own there? The right to getting paid from these people. If we've done the work but the money's not there yet, accrual or deferral? Think of the timeline. Accrual, the money's not there yet, is it? The last one. Oh, got to pay those employees. Think they're going to stick around very long if we don't pay them? No. Virakova pays its employees a total salary of $9,000 every Monday for the preceding 5-day week, Monday through Friday. On Monday the 29th, the employees were paid for the week ending on December 26th. So that gets a little bit messy. Basically, we have to pay them for the 29th, 30th, and 31st. But we're not going to pay them for just 3 days. That seems funny. So we owe them. We owe them money. How much? $5,400. Well, we're going to owe more than $5,400, aren't we? However, December 31st, our fiscal period ends, so we have to adjust for what happened. So we have salaries and wages expense coupled with the balance sheet of account of salaries and wages payable. Why is it $5,400 when I'm actually supposed to pay them $9,000 for a work week? The work week was only 3 days, Monday, Tuesday, Wednesday, to get us to December 31st, the 29th, the 30th, and the 31st. January, we'll turn the calendar to January. They'll keep working, and the employees probably don't even know that this transaction happens, do they? But we have to stop and adjust and clean up our books before the end of the fiscal period.